All right, lean in. This might be the most important investing message you hear this year. I've spent nearly 3 decades analyzing businesses, buying stocks, building real estate portfolios, and learning the hard lessons so you don't have to. Today, I'm giving you the blueprint I use inside Tag Premium, plain, practical, and proven. If you can focus for a few minutes and absorb this, you'll be miles ahead of the crowd. Real investing isn't hype. It's understanding businesses and making smart, repeatable decisions. In this deep dive, you'll learn how to find quality stocks without chasing trends, the real reason most investors fail, and how to avoid their mistakes. This is not get rich quick. This is get truly wealthy over time. Let's go. I don't pretend to have some mystical market view. What moves the needle is emotional control. 90% of investing is your mindset. Can you stay in when the headlines scream that you're wrong? Can you buy when prices are falling and everyone else is panicking? Can you hold a good company through a rough quarter? Warren Buffett says you don't need a high IQ, you need a steady temperament. I used to think investing was 90% numbers and 10% emotion. Now I know it's the reverse. The math is simple, the discipline is rare. And simple ideas must be repeated until they become reflex. Here are the tag principles I build around and teach our members to practice daily. Principle number 1. Every investment is the present value of future cash flows. When you put money into an investment, your eventual return comes from the cash the business generates, dividends, buybacks funded by real cash, and the company's growing ability to earn more. Sometimes it comes steadily. Sometimes it comes in spurts. Sometimes it piles up until a major payoff. Price is just the invitation. Cash flow is the meal. Principle number 2, be an investor, not a speculator. If the market shut down for 10 years, would your stake still pay you through dividends, retained earnings, growing customer bases, expanding margins? If your only plan is sell it to someone else higher, that's speculation. Enjoy it if you want, just don't confuse it with ownership. Principle number 3, stay inside your circle of competence. You don't have to know everything. You must know your lane. For me, that means avoiding complex commodity cycles and certain financial structures that I don't understand well enough. There's no penalty for passing. Principle number 4, price action does not validate your thesis. A rising stock doesn't prove you're right. A falling stock doesn't prove you're wrong. In the short run, markets vote. In the long run, they weigh. Your job is to keep measuring the business, not your feelings. Principle number 5. A great company can be a terrible investment if you pay the wrong price, and a rough story can be a good investment at the right price. Narratives seduce. Numbers convict. Separate the two. Your advantage is buying when the numbers and the narrative have temporarily drifted apart. Value versus growth is a false debate. All investing is value investing if you're paying less than what you'll reasonably receive in future cash. Growth is simply the path those cash flows take to get bigger. Our work is to estimate what a business can earn, what it must reinvest, and what's left for us as owners, and then decide what we're willing to pay for that stream. The mindset that wins is simple: discipline, patience, rationality. Charlie Munger put it best: we're not trying to be smarter than everyone. We're trying to be more rational than everyone. What is a stock? It's a share of a business. Not a ticker, not a toy. When the business compounds value, ownership compounds value. Eventually, the quote follows. Your biggest edge is remembering this when others forget. Look at any beloved company over a single year and watch the price swing wildly while revenues and profits barely budge. That gap between business value and market mood is where we earn our edge. How I evaluate a company, the Tag Premium way. The story, how does it make money? Who are the customers? What could break the moat? What would the world need to look like in 10 to 20 years for this business to still be thriving? The numbers, income statement, trends in revenue and margins, balance sheet, debt versus cash and flexibility, and cash flow. Is free cash flow rising and consistent with earnings? Free cash flow is the lifeblood, because leadership only has 5 places to send it: dividends, buybacks, debt reduction, reinvestment, and acquisitions. Good stewards prove it over time. Capital structure and returns, enterprise value, debt matters, and return on invested capital. High, durable ROIC plus opportunities to reinvest at high incremental returns. That's compounding magic. But size matters. Giants struggle to redeploy enormous cash piles at the same high returns. Small, disciplined companies can sometimes do it for years. The price we pay. I'd rather own a strong business at a fair price than a fair business at a story price. Price is the only input you fully control. The Tag 8 signals. My quick triage. Reasonable earnings multiple over a 5-year look-back. Healthy average ROIC over 5 years. Stable or shrinking share count. No serial dilution. 5-year growth in free cash flow. 5-year growth in net income. 5-year growth in revenue. Manageable long-term liabilities relative to 5-year free cash flow. Reasonable 5-year price to free cash flow average. Green lights don't equal buy now. They mean do deeper work. Red lights don't equal never. They mean why. The signals tell a story. You decide whether it's investable. Intrinsic value and margin of safety. Intrinsic value is your best estimate of what the whole business is worth, discounted to today based on the returns you require. Because the future is foggy and humans are fallible, you build a margin of safety, room for error. If you deeply understand an industry, you may need less. If you're stretching, you need more. Be consistent with yourself. 3 questions I ask before buying. Will this business likely still be relevant 10 to 20 years from now? Are its revenue, profits, and cash likely to be meaningfully better then than now? At today's price, can I expect an adequate long-term return? Yes to all 3 puts it on my buy list. Then I size it. Time horizon long-term is not 12 months. It's years. Sometimes a decade. Compounding works slowly and then suddenly. The IRS might call a 1-year hold long-term, but in real compounding, that's just the on-ramp. Expect this. After you buy, the stock will probably trade lower at some point. If the business is fine or improving, lower prices are a gift. If the business deteriorates, or you realize you misunderstood it, correct decisively. Process first, pride last. A word on buybacks. Buybacks create value only when they retire shares below intrinsic value and when the business is still investing enough for future growth. Done right, they quietly transfer a larger slice of the pie to remaining owners. Done wrong, they burn cash to manufacture optics. Judge the pattern, not the press release. Diversification versus concentration. You don't have to run a 7-stock hedge fund to win. For most investors, broad diversification plus steady contributions beats 90% of active managers. I personally own a mix. A core of low-cost index funds and a focused list of individual companies I understand. Whether you hold 15 or 40 names, the real rule is this. Let your winners run as long as the business stays great. Rebalancing that chops your compounders just because they grew is a silent tax on greatness. Macro noise, rates rise, rates fall. Elections, recessions, wars, shocks. Pull a 50-year chart of the market. The line of worry never goes flat, and the line of value creation grinds higher with human ingenuity. Good companies use tough times to get stronger. Your job is not to predict the next headline, it's to price cash flows with a steady hand. Behavior beats brilliance. Most investors destroy returns by buying late and selling early. They chase what went up and dump what fell. If you can simply reverse that impulse, accumulate quality when it's unpopular, hold while fundamentals improve, and trim only when price outruns value, you will be rare and rewarded. How we apply this inside tag premium. We teach you to read the story and the statements the same way, so you never have to guess. We screen for sensible valuations and strong balance sheets, then dig deeper together. We practice position sizing and patience, so your plan survives volatility. We use checklists, the Tag SIP Journal and Tag Stock Checklist, to keep emotions from driving the car. We lean on community, because you become the average of the investors you spend time with. A few lived lessons. I've owned winners that doubled, tripled, and then ran far beyond what I first imagined, because the businesses kept widening their moats and compounding cash. I've also sold too early and watched multi-baggers sprint away. The fix wasn't a new formula. It was a firmer hold on my best holdings as long as their engines kept purring. And yes, I've made mistakes when I drifted from process, especially when I tried to time valuation with shorts. Valuation is an expectation, not a clock. Lesson learned. Focus on buying good companies at good prices, not on betting against price alone. Your repeatable path forward. Decide your core, broad, low-cost index funds to capture the market's base return. Add your edge, a short list of understandable businesses bought at reasonable or occasionally wonderful prices. Systematize. The tagged checklists, watch lists, and journals keep you rational when it's hardest. Contribute. Dollar cost average through fear and greed. Review. Don't fidget. Track business results quarterly or semi-annually. Let prices wander without you. If the entire market truly went to zero, nothing else would matter. That's not a risk you hedge with fancy trades. That's the end of the game. Until then, the odds favor patient ownership of productive assets purchased sensibly and held long enough to work. You don't need secrets. You need principles you can actually live with. That's what Tag Premium exists to deliver: clarity, structure, and a like-minded community, so you're never making big decisions alone or in a panic. Keep learning. Keep your circle tight. Keep your emotions in the passenger seat. Keep buying quality at sensible prices. And keep showing up, because wealth favors the persistent.